Good afternoon, everyone, and a warm welcome to each of you joining this quarterly investment update with Cullimore, Dutton and Tatton Investments. Now, I'm your host, Sam Leary, and today you'll be hearing from both Lothar Mentel, who is Tatton's Chief Investment Officer, and also Dominic Richmond, who is Head of Financial Services from Cullimore, Dutton, and that will be followed by a Q&A session at the end. But just before we start, if you would like to ask a question, there is a box on the right-hand side or your bottom of your screen where you can send a question to the investment team. Now, without any further ado, I'll hand over to Dominic from Cullimore Dutton.
Thank you, Sam. Welcome, everybody, and thank you very much for joining today. My name is Dominic Richmond. I head up the financial services team at Cullimore Dutton. And what we do at Cullimore Dutton is we look after and support over 300 financial services clients. We advise on over 70 million of client funds, and we offer truly independent financial advice and financial planning. And we work with clients to help them achieve their objectives. We provide a one-stop shop alongside the legal services provided by Cullimore Dutton. And we like to think that we can really help a client in all aspects of their world. Thank you very much for joining. Today's agenda is a market update and outlook from Lothar, followed by a Q&A. And so, to echo Sam, without further ado, over to you, Lothar.
Thank you very much, Dominic, for that very kind introduction. We have got interesting times ahead again. It seems that in our world, we never run out of exciting topics. So hence that little cartoon that I've put at the starting slide. We are at the moment, or the capital markets are very much debating whether, for the first time in history, central banks will be able to get inflation under control by raising interest rates and still somehow manufacture a soft landing, i.e. doing that without the economy going into recession. Now, just this week, we had news from the IMF that the UK will be the only one amongst the big nations of the West, and even including Russia, to have negative growth for this year. Well, we'll have to wait and see. The IMF have not always got it right, but there are clearly a few headwinds that the country is facing. So in terms of what I would like to cover today, well, obviously, we are wanting to take a look into what 2023 is potentially going to bring us. But in order to do that, we always need to look back first. How did we get here? What are the building blocks for this year? And so for that, I'll be looking at what asset class returns we've had and what the market re-rating versus the economic resilience has been last year that we experienced. We then look briefly at the portfolio activity that we have executed in investors' portfolios last year. Then we move to the starting position for this year. We can already also, since we're now on the 2nd of February, talk a little bit how the first 12th of the year has started, and it hasn't started too badly, actually. And then let me try to present a bit of an outlook to the year ahead. So I always like to start with a really long-term picture of the UK main assets. I've used this ever since I started doing these sort of presentations pretty good 15 years ago. The FTSE in the blue line there has developed. We had this oddity over time that the green line, being the UK bond market, seemed to be pretty much catching up with the equity markets quite regularly. Now, as you can see, a big fork has opened up, and equity markets are clearly running away from the bond markets. And that really, in a nutshell, was the big story and what moved returns and valuations last year, that bond markets have really gone back to a more normal state, i.e. not yields around zero as we had them gradually since after the financial crisis 2008, 2009, and then really hit rock bottom in order to get us over the void of the pandemic. That is now changing. Inflation has come up, and therefore bond yields have normalized. So on the next slide, we have the table of the investment returns for 2022. Apart from the UK, really, it's a sea of red. And before we get too excited about the UK having had a positive year, I mean, it's probably relatively easy to see that that was more of a catch-up if we look at 2021, when the UK was clearly underperforming, and indeed had been underperforming since 2016. But last year, the UK had a year in the sun because there are a lot of companies in the index that had fallen out of favor in the previous years, namely energy, oil, resources, banks, all the things that perhaps the more sustained investment fashion of the previous years were shunning, but last year became an utmost necessity. The important point there, perhaps to see is that bonds, which normally do not sport big negative returns, hence why they're in the portfolio, as risk shock absorbers, did not do that job last year. So it was one of those years where they're rare, but where returns from both equities and bonds were positively correlated, i.e. they moved in tandem, which they're not supposed to do, but unfortunately sometimes do. So on this next slide, we can see just how rare these sort of years are, where you have got volatility, which means that we've taken the big US market here as the example, where you've got daily moves above 1% in the index, and we had 65 of those. So we have to go back to the financial crisis to see a similar year like that. So it was quite a volatile and windy year, if you like, to see in those terms. So unfortunately, that meant that there wasn't very much that you could make in positive returns anywhere in the world. Well, we saw there was a bit of positive return to be had in the UK. We were grateful for those returns, but otherwise it was all in the negative, as it sometimes happens, and as it is unfortunately part and parcel of being a risk premium investor, i.e. that risk premium is earned by investors over and above what might be otherwise available from government bonds or banks, because they are taking this risk that from time to time things aren't quite as good. And then our job is to navigate portfolios through this, make sure they're not getting hit quite as hard, perhaps as without any portfolio management, but also our position in a way that they then take part in the recovery that comes thereafter. So again, such years where we have those negative returns for equities and bonds are rare, as we can see on this scatter diagram, and we can also see that 2022 here is not accompanied by many other dots. It is not therefore something that we would expect again for this year, and indeed many of those instances have been followed by years that looked a lot better. Now, it wasn't just the UK where you still were able to make money. There was also style rotation that added value in portfolio management, and indeed we over the previous 18 months had rotated our portfolios from a slight growth tilt more to a core value tilt. And as you can see on this slide here, if you look at the different regions and to the different style sectors, those in blue are value, those in red are growth. So think of growth as those tech stocks or investments into the future, ESG share stocks, which have to invest heavily now, but where the returns are only likely to come sometime further down the line, as being the growth shares. And when yields rise, they do particularly badly. But value stocks, which had not got a good time the previous years, had a very good time in that period. And there were only very few markets, like the emerging markets, where value still produced negative returns. And that opportunity has not necessarily run out of fuel yet. So as we can see on this chart, value underperformed for a long, long time, i.e. since the financial crisis, as yields fell and fell and fell until they've turned. And so you can see that almost as a function of yields, i.e. when yields go up, money becomes more expensive. Capital isn't free to be had anymore. Then those who already have capital and produce earnings now will get a better valuation dynamic than those growth stocks that need a lot of capital and will only return returns or positive profits and dividends further down the line. We need to keep in mind, though, that last year was not the total exception for the stock markets, because if we look at this quite longer term trend there that goes back to the early 1990s, that trend channel hasn't really changed particularly through what happened last year. We have seen much bigger deviations from that back with the dot-com bubble in 2000 and then the financial crisis in 2008-9, and we've really seen a good uptrend since then. And that wobble that we had last year has not been really a divergence from the long-term trend. So no reason to believe that things have changed just because we've seen a correction in the equity markets there last year. Because what we do need to keep in mind is that it's the bond markets that have really changed. And what does this chart here show us? Well, it shows us the long-term development of yields, and the global anchor yield, if you like, is what the US government pays on 10-year maturity government bonds. And we can see here that really rose to the early 1980s to double-digit figures of a good 15 and some percent, and ever since fell and fell and fell until during the pandemic. Even in the US, those rates almost went into the negative. They were at 0.5, but we had many governments, including much of Europe, particularly Germany, where actually there were negative yields that were paid. And that is where the big change has happened. You can see there towards the end of the slide of the chart here that we're really seeing a trend change here. The yields have come back up. They're back in what we would probably regard as more normal territory of 3.5 to 4.5%. That's good news in a way for new bond investors, for those who are coming into the market now, because that's the sort of return that you can expect. But unfortunately, what we've been saying for years has come true now, which was that I just dug up this slide from 6 years ago, that bond markets just had run out of road, and that if at that point in time your 10-year yield had fallen to around 1%, well, that's all you could expect for 10 years. And if then the return from that bond was 3 or 4% because yields fell further over the coming years, then that would have to be recouped through a fall in the value. And that's exactly what happened. So what this chart showed here was the period after the Second World War, in the run-up all the way to the early 1980s, the high inflation environment, how yields had forever risen, and how in the right-hand panel markets had behaved, i.e. in equity markets, you had an annualized 12% return, but there was hardly anything to be had from the bond markets, because even though you got better and better yields, the existing bonds always therefore shed value. Whereas in the second period, where yields forever fell, you had very positive returns from the bond markets, because the existing bonds with the higher coupons always gained in value, and therefore, if you like, had a booster to their value, whereas equities didn't. And we said, well, it can't be repeated, because once you hit zero, you've run out of road, and that won't repeat. We said we're not expecting a replay of that period we had between the Second World War and the 1980s. So that's not what the future will bring. We just said it's unlikely that over the medium term, bond yields would stay at the lower zero bound, i.e. around zero. They would come back up, and that is exactly what has happened. And that has had repercussions for the equity markets, where for, well, pretty much until 2021, the abbreviation TINA made the round. TINA just meaning there is no alternative when trying to explain and justify why equity valuations were running higher than historically had been the case. And the reason was that the dividends, the growth that came from the stock markets was the only one available. There were no positive returns, particularly after taking into account any form of inflation. There was just no alternative to bonds, and that made the returns that were available in terms of dividends and corporate earnings from the equity sector so much more valuable, as we can see on this chart. And since that has changed the year before last, so from December 21 to November 22, we can just see how much the yields have increased there from very meager Germany minus 0.2 to now 2%, and that's going to rise further in the US investment grade from not even 2.5 to almost 5.5. So in the right-hand panel, we can see how the equity dividend yield, so if we just look at what sort of yield comes from equities in the dark green line, has over time now been overtaken once again by the bond yields, the lighter green line. And that was reflected, unfortunately, also in equity valuation. So what this chart here shows us, and this is a global equity market chart, so the blue line is the global equity markets, and how they've performed if they were just running on a fixed or static basis as a fixed multiple of the earnings development. They would have followed one of the either yellow, red, or green line, which are just different multiple levels that one could think of. The long-term average is around 14.5. We can see how over the previous years that had been abandoned, or markets had been valued higher at a good 18 times corporate earnings, and that was then explained with there just not being an alternative, whereas now there is a real alternative in the bonds. And that's what this shows and tells us, is that the decline in equity markets had not that much to do with the actual underlying economy, because those earnings, as they developed, as we can see in the green, red, and yellow line, kind of came down slightly, but more or less went sideways, whereas the equity markets really experienced a major revaluation, because there is now, once again, competition in town, and that's bonds, and that has made the relative value of equities less. So what were the major market moving dynamics? Well, at the end of the day, it was a sort of typical boom to bust type in environment. As it turned out, the pandemic was not the mother of all recessions. It was a very short recession, which thanks to the very distinct actions of the central banks and the fiscal support from governments, did not become a terrible experience. But that meant that the stimulus that was applied once we came out of the pandemic was too much. That led to more demand than there temporarily was supply, because shutting down the global economy really did put things into the wrong places, and demand patterns changed in the shorter term when everybody wanted to have a Peloton or something else that they could use at home, whereas the industry was geared towards other things and services. So that together with commodity price pressures from an underinvestment in commodities had already led to higher prices, which up to that point were seen as transitory, because we always knew that there was more supply than there was necessarily demand. That was the experience of the previous 10 years, and that it would come back. But then we had the Russia-Ukraine war, which unfortunately led to another price shock on the energy side, which then forced the central banks to recognize that these increased price rises were not going to be transitory, but potentially going to feed into that dreaded wage price spiral, simply because, and that was something that had not been expected, this pandemic, just like pandemics in history, did lead to a tightening of the labor market, not because anybody at working age in the labor market had fallen victim to the pandemic. That percentage was quite small, but a lot of people in the age bracket between 55 and 70 all of a sudden decided that life was too short to keep working, and perhaps enjoying retirement with a little bit less money was worth their while. And so we saw a big exodus from the workforce, which then meant that in conjunction of a price shock and a stronger negotiating position of labor, of those who can choose where they want to work, led to big concerns that we might return to what we saw in the 1970s, i.e. a wage price spiral, which would explain why central banks increased so strongly the interest rates and faster and in bigger steps than we had seen for a very, very long time. The China zero COVID policy, in a way, was almost a positive last year because as there was more demand for energy than there was supply, it wasn't that bad that most of China kept being locked up and not that much flying, driving, and therefore their drawing on resources wasn't quite as pronounced as it would normally have been. And equally, because they're out of sync with the rest of the cycle around the world, as we are feeling less demand coming through from consumers being under cost pressures, China's coming out of a very, very long period of intermittent lockdown and a lot of catching up, pent-up demand, which is going to be a positive shot in the arm for the global economy. Now, if the price shock of last year was really what put Western consumers under stress, we can see that actually those price shocks are increasingly coming down. You've probably not yet seen it in your utility bill. I definitely didn't see it in the utility bill that drifted into my inbox yesterday. That was still a very elevated level, but the prices are coming down, and therefore that transitory element that central banks were talking about more than a year ago is really coming through. And the same is increasingly true for the labor market as well, where while unemployment rates were really coming down, now recently we've seen the wage growth pressures turning and coming down themselves. So we've seen the wage growth not being perhaps seen as such a big issue going forward. At least it's now going in the right direction, particularly in the US, where we saw a real shooting up because they had the tightest labor markets and also the most if you like, dynamic labor market, where during the pandemic people had not been put on furlough but just been let go and been supported by the government, and therefore when they came back they were able to choose where they wanted to work and negotiate new wages, whereas in Europe with furlough that was not the case, and you had a very different approach from labor, from workers perhaps towards the workplace, a bit more gratefulness than there would have been in the US, and therefore less wage pressures. Now, the UK labor market forces are not dissimilar to what we've seen elsewhere. So unemployment down, wage growth up, but also slowly coming down. Now, with that, the summary, it was about higher yields last year. It wasn't yet about the economy. It was the labor market that really put the fright into the central banks and led them to raise interest rates so much. Politicians sometimes didn't help the process, so that hapless UK government last autumn causing a global storm in the bond markets was certainly something we could have done without, but that has all pretty much calmed down at the moment. So moving on then to how we position the portfolios. I'm not going to go through every point in here, but just like to say that last year kept us quite happy, quite busy, and moving the portfolios, adjusting them to the prevailing trend. So as I'd already said, we had done a gradual rotation from our tilt towards growth towards a tilt towards core and value, which was a good move. We went from our overweight in equities to a neutral to slight underweight in equities, and did various regional exposure changes, particularly towards Europe and towards China, which particularly paid off towards the end of the year. And in order to illustrate that in a little bit more detail, we have it here across all the different asset classes where we stand. So at the moment, we have taken an underweight position to the US, which continues to look relatively highly valued in the equity markets, while facing now the stronger headwinds compared to Europe. And in Europe, it seems that the worst has passed, the blackouts haven't happened, and a relatively milder winter has helped to overcome that shortage of gas. Nevertheless, we've always got sort of hits and regrets, if you like. So very positive and happy we were about the underweight to US large cap growth and tech, because they lost very significant amounts of value last year, as you might have read, alongside what had become quite correlated with tech, i.e. cryptocurrencies. On the minus side, we were a bit early with our China position. We were a bit early with our Europe overweight versus the US, and it would have been beneficial to have more cash in the portfolios at the beginning of the year, rather than the duration position that we had in the main and emerging markets. However, in an environment where inflation is rising, we are always quite loath to holding cash in portfolios where we have a guaranteed loss in real terms. Nevertheless, altogether, when you review the performance with your advisors, I think you will find that we've done relatively well, at least on a relative basis compared to our benchmarks and our competition. The volatility of last year is unfortunately something that is part and parcel of investing. Now, for those who think that last year has proven that a portfolio, it's in the industry called the 60-40 balanced portfolio, is not something that is particularly positive anymore because of what we've experienced. Well, Sam and his team have put together this very helpful table here, which shows that that minus 6.8% return that we saw, unfortunately, there last year from such a mixed portfolio has seen worse in the past without it being abandoned as a good risk profile for clients. And as the table on the right-hand side shows, quite often after a negative year, the next 12 months turned out to be pretty positive for such a mix of assets. So despite of what we might read in the media, things this time around, at least for us in the investment profession, are relatively classic in terms of it's been a boom to bust sort of environment that we've gone through. Yes, the movement in the bond market has been a bit unprecedented, and a lot of what had been expected would normalize over 3 or 4 years, unfortunately, came back in 1 year. But otherwise, this is for us far more foreseeable at the moment in terms of development than when we stood ahead of the pandemic, and it was really not quite clear how things would develop when societies decided to completely shut down the economy. That was certainly more of uncharted territory than what we're experiencing at the moment. So with that, let's move on to our outlook going forward. And I always like to start a new outlook with an old outlook, i.e. what did we say last time? And in this case, our last update presentations would have been in the autumn of 2022. And the things that we put down there did pretty much come through. So that the inflation scare would eventually come down, that energy price developments would be the decisive factor together with job market tightness. Both of those have eased and therefore have helped equity markets in general, also bond markets in the last quarter, but also in this first month of the year towards more positive returns than we saw for most of last year. We said that this soft landing versus recession would continue to be the swing factor. At the moment, the jury is still out, but the markets are almost pretending to already know that that's what's going to happen. We wouldn't necessarily want to be quite as convinced about that. We still think that a bit of the jury is out on that, and it's a bit more wait and see. Hence why we're not yet loading portfolios with more risk than is appropriate in this market environment. And we said that regional style rotations would offer opportunities to growth value, China, Europe, US, all those things did come to the fore. So the interesting point now is that the outlook for interest rates as priced in by markets rather than projected by central banks is foreseeing that we have pretty much reached the end of the rate cycle already, and that quite immediately after the rate cycle, interest rates will fall again, i.e. central banks will immediately turn 180 degree and start cutting rates again. And that sort of expectation has increased, as both these charts show. There's a higher line, which was a while in the back. And now the more recent line is showing quite a drastic fall from higher yields, which is giving both equities and bonds a bit of upside at the moment, because as we discussed early on, if there's less to be earned in the bond markets and in cash, then the more attractive it is for the economy and for stocks. So it waits to be seen. We've just heard from Jay Powell last night at the US Central Bank that they're not necessarily expecting to come down with interest rates before the end of this year, although by saying that they were obviously also watching the data very closely and would be taking that into account, led to markets believing that they were probably not quite going to be as strict as they're saying, at least in their formal statement. So hence why we had a relative positive market reaction to that yesterday. And perhaps the markets are right, because for the first time we're now also seeing business expectations ticking up again, as these two panels here show us for different regions around the world. Particularly notable how much it is currently going up in China. Apologies for different color schemes between the two, but you can see that China is ticking up particularly strongly, which is one of the important points really for this year. We all remember how much economic dynamic a reopening brings, and that seems to be the same that is happening in China at the moment. Nevertheless, they're still at that point between expansion and contraction, which tells us companies are still somewhat nervous about the big rate rises that we've had last year in the US, now at a good 4.5% in interest rates. That is something that usually only feeds through as a slowing element into the economy with a 9 to 12 month lag. So perhaps no surprise that investors are still quite concerned about it. And all the GDP estimates that came out last year therefore reflect that. So these are consensus estimates of global GDP, which shows that really it was only the east of the world which was seen to be producing positive growth rates for the economy, and the UK really being singled out as the worst. As I said, we'll probably have to have a look whether that really comes through. And it's not just the businesses where sentiment has been ticking up. We've also seen the turnaround from very low levels in the UK, in the Eurozone, and even in the US, where they hadn't fallen that much. We're ticking up again. So consumer confidence has been recovering for a bit longer, and now businesses have picked that up, as we saw in the earlier slide as well. And quite a bit of that does come from the observation that the economy has been more resilient than had been feared to the rate rises, but also to the price rises. And now also the hope that while the Western consumer demand has to slow and will slow, there is compensating demand coming from China, where all indicators of bouncing back at the moment tell us that recovery rally that we experienced in the West is also going to happen in China. Now, that's what made us quite happy to have taken a position in China, at least in our overlay funds, because markets, as you know, are and anticipatory, i.e. they look forward, and even though China was really still very much in lockdown towards the end of last year, it was foreseeable that this stance would soften, and hence why China in the last quarter of last year outperformed every other market around the world, even though they haven't yet caught up over the longer term with the developed world. Overall, though, as this chart shows us, at least on the historical measures of the multiples that I showed early on, i.e. how our stock markets valued as a multiple of the underlying earnings, those blue diamonds here show us that they are now, in most instances, except for the US there, valued at a lower rate than the historical average, which is indicated here by the green bars across those range bars for the different regions. Now, does that make equities a really good opportunity at the moment? Well, we're not quite there yet, I'm afraid, because as I said early on, there is now an alternative. And if we look at the premium that you can earn by being in equities over the premium at a similar risk that you would be able to earn from corporate bonds, well, that at the moment is still under the average line, and therefore that does make equities still look a little bit expensive, at least if it's not a soft landing, but a bit more of a contraction, i.e. recession. However, on that side, interestingly, the biggest early warning indicator, which is credit default spreads, are telling us that investors are not fearing a major credit cycle, i.e. not fearing that we are going to go for a major recession. Yes, there is some elevation, and we will see some companies now with higher rates for their capital requirements, perhaps folding, but not in a way that would normally be associated with a recession, as the peaks there on the chart in previous periods were indicating. So the biggest canary in the coal mine is at the moment not giving us the signals that it will be a hard landing. It's all from those market measures telling us it's a soft landing as well. So at the moment, and that's the reason why we haven't yet changed our overall stance of risk neutral, is because there's a balance between negatives and positives. So it is great that the central banks are aiming for a soft landing, and just last night we did see that they are not going completely, that they're not ignoring the falls in the prices that originally caused inflation to rise, but they quite rightly also pointed to the still tight labor market, which could mean that average price rises will not go back to the 2% level where they want to have that, but perhaps stay higher between 4 and 5% for the foreseeable future. So not the 10% anymore, but still at 5%, which would mean that central banks would also have to keep interest rates at roughly that level. We spoke about China bringing a positive growth impetus into the global economy, and the reverse of the strong jobs market is also that economic downturns don't tend to be particularly harsh if people don't lose their jobs. So if we all think back to the financial crisis, which was a major crisis for corporate earnings, but because people weren't really losing their jobs, it wasn't felt as such a terrible recession for most who already had a job, i.e. weren't just coming out of university. And therefore, even with the higher cost of living crisis that we have, particularly in the UK, and the higher mortgage rates, that's still, at least historically, been seen as bearable as long as people still hold on to their jobs and can sometimes even find better paid work if they can't meet their bills anymore. And then last but not least, or Europe avoiding the worst of the energy crisis has obviously been a positive that has really been positive for markets over the course of January as well, where Europe has seen really some tailwinds compared to the US, where things have been a bit tougher. However, the headwinds still exist. As I said, whenever central banks have in the past tried to cool the economy and labor markets by raising rates like this, a meaningful recession has followed. So this would be historically the first time that that doesn't happen, which therefore means those who've been around for a little bit longer are taking it all with a pinch of salt at the moment. So we are seeing a big return in the US of retail investors who've started to buy their beloved tech stocks and cryptocurrencies again with the savings or with the cash that they're now not earmarking for price rises anymore. But the institutional investors, the hedge funds, the pension managers have not really re-entered the higher risk plays yet, because it is all but certain that the company profits, the earnings will have a downturn, even though we have to admit the earnings of the last quarter at the moment tell us that they have just stalled. They have not yet declined, and in Europe they have even risen. But the question is, therefore, with the strong rally that we've recently had in global equity markets, but particularly in Europe and China, has that already priced in much of the good news? And we now really are in a wait and see period where we have to see whether it really pans out and goes towards a soft landing in order to see any more upside in the equity markets. And then China, unfortunately, is also a bit of a double-edged sword in that, yes, the demand is great for industrial production around the world and consumer demand, but unfortunately, they're also therefore going to compete with those scarce resources, which have been causing the price shock in the first place, i.e. energy and raw materials. And that could therefore mean that the nice price falls that we've seen in those areas over the last 6 months may stall, may not go any further as China starts to consume again. So in a way, I've already spoken to much of what our outlook for this first quarter on the economy is. The soft landing is starting to look increasingly possible, but we can't be certain about it yet. It's looking less easy to avoid in the US, maybe not a recession, but at least a downturn, because the labor shortage there is much more pronounced than in Europe. However, that could actually be a benefit for the global picture, in that usually drives down the value of the dollar. And indeed, that has already happened since the turning point last year in November. And a lower dollar tends to be really strong and good support for the global economy. With markets, we therefore are not getting yet extremely excited about the upside, but we're equally not particularly concerned about the downside anymore. There will be volatility. It is even possible that we could see a retest of the lows of last October, only for markets then to bounce back as they see the better economic conditions ahead. But overall, I would expect that this year ends on a more positive note than what we had in 2022, and that our strategy of positioning portfolios towards those things that still do well in those environments will add value to your portfolios and will hopefully end the year on a more positive return note than the last 12 months. That brings me to the end of my slides, and I'm now very happy to answer any questions that Sam may have collected in the meantime. Over to you, Sam.
Yeah, thank you very much, Lothar. And first of all, a very big thank you to everyone that posed questions on the session today. And I just want to remind everyone that if you do have any further questions, please don't hesitate to speak to your advisor at Cullimore Dutton. Now, just on very quickly to the first question. Now, Lothar, one of the very big questions that we had, particularly over the course of the last hour, was around the outlook for the UK. And when we look at the performance of UK stocks last year, they did seem to perform a little bit better than other parts of the world, but economists seem to have a bit more of a negative viewpoint about the outlook for the UK. So particularly over the course of this year. So are things as gloomy as these forecasts might suggest for the UK economy?
Yeah, so there are a couple of points we need to keep in mind here. Firstly, the UK stock market is not necessarily a reflection one-to-one of the UK economy. UK companies are global operators and oftentimes very much geared towards resources, energy, finance, and all those things do well when the economy globally goes into a recovery. So if the rest of the world goes and continues on a recovery path, then that should continue to bode well for the UK stock market. That isn't to say that the UK economy is facing a few more headwinds than perhaps Europe and the US, because as we have heard, as I said early on, one of the big issues has been the shortage of labor and the relative higher hurdles for immigration over the last 6 years have meant that there is a bigger labor shortage factor in the UK than there is perhaps on the continent. And unfortunately, we also, in order to participate really in the upswing of economic activity amongst our neighbors, we will have to somehow get to some sort of trade arrangements as well, which aren't quite as a harsh Brexit than as perhaps currently is. So do watch the space here. At the moment, we hear a lot about Northern Ireland movement being in the pipeline, and perhaps a slightly more sensible trade arrangement to come forward than what we had over the last couple of years. So I think the jury is out for the UK. UK investors are probably having less to worry perhaps than people who've just started their career and looking for economic vibrancy in the UK. But there are a lot of things that the UK has, if we're just thinking about expertise in renewable energy sources, for example, and various other things, where the UK could really surprise on the positive side and certainly surpass those pretty dire forecasts that we saw coming from the IMF, which sounded a bit like they were also predicated and based a lot of what happened just after that bond storm that was caused last year by that hapless government.
Thank you, Lothar. And another very popular question was, and you did actually touch upon the very rapid movements we saw last year in both bond prices and the very significant jumps up in the yields that they now offer. So I'm just wondering, what do you think we can expect from fixed income investments over the course of this year, maybe the next couple of years?
So the big move should have happened, has happened. We're not, and markets are not expecting a similar step change again. And as we saw on the charts, the interest rates are also not expected to continue to rise, and indeed are even expected to come back down potentially over the next 12 months. So that means that the returns that are now locked into portfolios with yields of around 3.5 to 4.5% are what we, if there's no more particular movement in yields and therefore the valuation of bonds, that's sort of the return potential that we have there going forward. The losses of last year that came from the bonds and were really a correction of all the things that had overperformed in the previous 6 to 10 years, as we laid out, will take a long time to recover. But at least from here now, the path forward and the view forward is a more positive one. And with 98% of our portfolios being at least run with an equity proportion of 45% to 100%, I'm pretty optimistic that we can continue to produce positive and inflation beating returns again for clients in this market environment.
Thank you. And that actually concludes the question and answer session for today. And then I just want to thank everyone effectively for joining us today, and also Lothar for his presentation. So we do always hope that you found today actually useful. And finally, I just want to hand back over to Dominic from Cullimore Dutton, who will finish today's session. So thank you.
I have a feeling that Dominic is, oh, there he is. Dominic.
Thank you. I never said I was technical. Lothar, thank you very much. That was informative, and anybody watching the video can see that I'm at a certain age where, like any client and like any investor, these things matter. And I thought it was really interesting that you and your team have a focus on two things, and that is to try and identify opportunities to grow clients' wealth. And for us as advisors, that's really important because it allows us then to work with the client to deliver their objectives. But the thing that really struck me is that it's really important as a client that when times aren't great, that when the pound you've invested falls, it doesn't fall more than it should. And I thought that came across, that level of intrusion, that level of investigation and knowledge you have, because that's a really important part of investing. So thank you for that, Lothar.
Thank you very much, Dominic. I'm glad if that came across.
It did. It could be my age, but I think that's such an important part of investing as a client. And I'd like to thank everybody who's attended today. Thank you very much. It is appreciated. You've taken time out of your days. I will be writing to you all over the next couple of days, again, as a thank you. Secondly, to ask for your feedback. And of course, if there's any questions that you have outside of the webinar, then please feel free to ping them to Lothar, to myself, but I will be dropping you a line over the next couple of days to thank you. So thank you very much. And to the team at Tatton, thank you for organising as well.
Thank you, Dominic. Take care. Bye-bye.
Take care.